Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So in this video, we're going to be talking all about dividends, why I don't necessarily like dividends as much as a lot of people do. And this is a video topic I've covered on the channel a couple of times. And I'm making this video again for really two main reasons. Firstly, the channel has grown quite a bit since the last time I made this video. And secondly, I think it's still quite a misunderstood topic in terms of a company being good just because it pays a dividend, or a company being bad just because it doesn't pay a dividend. And I think capital allocation in general, which is really what drives dividends and whether they should be paid or not, is quite a misunderstood topic as well. So I want to talk through why I don't necessarily like dividends in this particular video. In some cases I do, in some cases I don't. Hopefully you will understand why or why not by the end of this video. And this is really an area that I disagree with a lot of people on. So a lot of particularly newer investors really like to get paid dividends every quarter or every 6 months or every year, or whatever it is. I'm not in that boat. I'm looking for the largest absolute return I can get over time. Whether that comes from dividends or capital gains will depend on the group of investments that I've got in my portfolio at a particular point in time. And I don't have these rules like someone like Kevin O'Leary might have, for example, where he will only invest in dividend-paying stocks. I actually, in a lot of cases, prefer stocks that don't pay dividends and can go ahead and reinvest their profits to grow the business faster than I could grow that capital if they were to pay it out to me. So in this video, I'm going to talk through Chipotle Mexican Grill. This is a favorite company and very successful investment of one of the people who's taught me plenty about investing, which is Phil Town. So Phil Town bought into Chipotle at about $50 a share, probably about a decade or so ago, rode it up to about 500. So collected about a 10x on that investment. It then went back down to about 250. He bought again at 250. Again, sold around 500. Unfortunately, it's more than doubled since he sold out. But nonetheless, it's a business he understands very well. And for that reason, I've picked up a lot about Chipotle as well. So Chipotle, to my knowledge, has never paid a dividend, and there's some pretty fundamental reasons why, and it's going to serve as a really good case study for this video. If you do enjoy, please hit like and hit subscribe, but for now, let's get straight into it. Now, just quickly, for those that have been living under a rock, and possibly our New Zealand viewers who don't know what Chipotle is basically a Mexican fast food restaurant. They make burritos amongst many other things. They have a slightly sort of higher quality, more healthy type product than something like a Taco Bell. A little bit more expensive, but not as expensive as some sort of fancy restaurants or anything. It's a type of thing where you might go to, a couple of times a week for lunch, a little bit like you might with sort of Subway here in New Zealand, I suppose. So that is the very dumbed down version of what Chipotle does. And Chipotle has an interesting twist in terms of how they run their business model. So a lot of fast food restaurants are franchises. Take McDonald's, for example. If I wanted to, I could go out and try to start a McDonald's franchise, somewhere near me where there wasn't already one that had popped up. Chipotle doesn't do franchised restaurants, so they own all of their restaurants, and that's kind of the key difference in terms of the business model with Chipotle versus something like a McDonald's. And the business over the past decade or so has been very successful. They've grown up to around 2,600 or so stores. I will put up a screenshot here that will show you their sort of revenue and then their net income growth over time. And you'll see they've been an absolute growth beast, and the stock has also gone up to reflect that. And it's been a fantastic investment for people that have held Chipotle for a long period of time. Now, why have I chosen Chipotle to talk about when it comes to whether or not a business should pay a dividend and whether dividend payments are a good thing for investors of Chipotle? Now, just as a bit of background, Chipotle currently has around 2,600 stores in the US. They have focused almost purely on the US. They really don't have any international stores. As far as I know, at least if they do, it's not very many. And you compare that to something like McDonald's. Now, McDonald's has about 14,000 stores in the US alone. alone. So they're at about 6 or 7 times as many stores as Chipotle just in the US. And it means that Chipotle still has a very, very long runway for growth. That doesn't mean that they're going to get to the same density as a McDonald's, but they can certainly get to much more than 1/6 or 1/7 of the density of McDonald's. They've got a long runway for growth, and they've still got the opportunity to go international as well if they do ever see slowing growth in the US. And the main driver for growth from Chipotle has simply been building new stores. They've been putting in 150 to 250 new stores every single year, and they've been actually getting really, really good returns on those investments in terms of setting up new restaurants. And the decision from Chipotle management on whether or not you should pay a dividend out to your shareholders should basically go like this. Are our shareholders going to be better off if we spend this money on opening new restaurants? Or are our shareholders going to be better off just being paid a cash dividend from us, from Chipotle? And basically we need to go through the numbers and figure out what sort of return they can get on opening those new stores versus just paying out a dividend. So, if we pay cash out to a shareholder of Chipotle, they can maybe go out and reinvest that cash in an S&P index fund and expect maybe 8 or 9% over the long term. So our new stores, in order to justify opening new stores rather than paying out a dividend, we need to be capturing at least 8 or 9% returns as kind of a floor on that investment. If we can generate less than that, it's really a dumb idea and we should be paying out dividends. And if we can generate more than 9 or 10% a year reliably, then it might well be a great idea to continue reinvesting the profits in order to grow the business and open new stores over time. So let's have a look through some of the numbers for Chipotle. So right now, Chipotle brings in around $350 million a year in net income and profitability that, they pay their taxes on every single year and that sort of thing. And they're doing that across about 2,600 stores. Now, if we do some really basic calculations, and this may be a little bit crude, but you will get the point. If we divide that 350 million by our 2,600 stores, we get a net income per store of a little over $130,000. Now, that means that if Chipotle goes out and continues to grow their store count, they should expect to get roughly $130,000 in net income per store. Some stores will be higher, some stores will be lower, depends on where it is and how successful that new store is. But if you're doing this at scale, if you're opening 100 new stores, on average we can expect that maybe Chipotle will get $130,000, maybe $150,000 per store in additional net income from opening those new Chipotle restaurants. Now, the next logical question, if we can get that $130,000 per store, is how much does it cost to open that store and get the $130,000? If it cost $1 billion to open that store, $130,000 isn't going to be meaningful relative to what we put in, and that's not a great investment. So we need to look at how much it actually costs to establish that store and get our additional $130,000. Now, in 2019, that number for Chipotle was $860,000. Now, if we divide our $130,000 net income by our $860,000 establishment sort of price for that new restaurant, that gives us right around a 16% return on capital. Now, when we compare that back to our 8 or 9% that our shareholders could potentially, take that cash and invest it in an index fund with, 16% a year looks very, very attractive. If it's double that 8% that shareholders could get if they were to go out and invest that in an S&P 500 index fund. And the other thing that we can have with these Chipotle restaurants is the return that we get on these restaurants is likely to be much more reliable than an index fund. Although the stock market does 8 or 9% a year over the long term, or at least that's what it's done historically, we get massive fluctuations. So some years it might go up 30%, some years it might go down 50%, and it's a very wild ride. Whereas with Chipotle opening these new stores, we have a relatively reliable source of new income. Chipotle have a very long track record of profitability at this point, and they've executed extremely well on opening these new restaurants. So if we compare 15 or 16%, not quite guaranteed, but a pretty reliable, chance of getting that from opening new restaurants versus possibly 8 or 9% if you hold on to it for maybe 20 years, that's what you might get over a long period of time. It's a no-brainer for Chipotle to open the new stores rather than paying that cash out as a dividend. And the other thing that Chipotle has on their side is they've got this long history of increasing what they call same-store sales. Now, same-store sales, as the name suggests, basically looks at one particular store, and they look at how much the sales increased year over year over year. And with Chipotle, the numbers have been exceptional. I'm going to put some same store sales growth numbers up on the screen here. And basically my point here is that if Chipotle does go out and open a new store and it earns $130,000 a year in net income on it in its first year, we can expect reasonably that $130,000 is actually going to grow over time. So, you know, it might be $130,000 in the first year, but maybe the next year it's $150,000, and the next year it's $170,000, and the next year it's $200,000, and they only had to invest that $860 upfront the one time. So we've got these sort of two tailwinds from Chipotle. Firstly, the restaurants initially are very, very profitable. Secondly, they have the ability to become even more profitable over time as those stores get established and as the Chipotle brand itself continues to grow. Now, if you happen to be Warren Buffett and you've got a long-term return history of 20% a year, then maybe 16% doesn't look so attractive. But for mere mortals like me and you, you know, if we can crank out 16% a year over an extended period of time, and Chipotle again has a long runway to go out and achieve this growth. If you were to go and do that in your own investment portfolio and make 16% a year for 20 or 30 years, you would be an all-time famous investor. That's like Seth Klarman type level, that's Charlie Munger type level, or at least getting very close to it. So, you know, if we can take an almost guaranteed return from Chipotle opening these new stores, it's an absolute no-brainer. If Chipotle were to say, you know, we still think we can double our store count, but we also want to pay you a dividend at the same time, that would be a dumb idea. It would slow their growth, and shareholders would actually be worse off over a long period of time versus if Chipotle just retained all those earnings and reinvested them in the business. Now, whether or not Chipotle stock is a good investment at the current price is an entirely different question and not the topic of today's video, so please don't take this video as go and buy Chipotle stock or anything like that. It has performed very well, but as much as I really like the business and as much as Phil Town really likes the business, both of us seem to think it's expensive because I know Phil doesn't own it in his portfolio and I don't own it either. So that's my current thoughts on the stock, so don't take this as a stock tip and, you know, just go out and buy Chipotle. But I hope that does serve as a useful case study on whether or not a business should pay a dividend. At the end of the day, the equation is pretty simple. Are shareholders going to be better off receiving cash and being able to invest that themselves, or are they going to be better off if you reinvest that within the business? And, you know, that is about as complicated as this topic has to be. A lot of people seem to think that, you know, if you get paid a dividend by a business, it's much better than a company that doesn't pay a dividend. It's not always the case, and you really need to look at what the business is actually going to do with that cash if they were to hold on to it. So I hope you enjoyed the video. If you did, please hit like and hit subscribe, and I will see you in the next one. Cheers.